Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us this week, where we're going to cover a few of the things that we hit in this week's investment allocation meeting. Also thankful for all of you who had a chance to come out and see us for the thirdly or join us on the digital one. And here we are moving on in the markets, getting past that era. And today we're going to take a look at an update to the historical bond market, something we've hit a lot, but I've got a chart that adds some context and an update to one we presented earlier in the year. Talk a little about real estate, something we don't hit a whole lot, but we'll certainly have context from time to time. Andrew's going to hit on Nasdaq 100 stocks and give us a technical update. And then also some great context for inflation and paths that it needs to take in order to get back to what at least the Federal Reserve would call an expected normal. So we'll jump right in and talk about the historical bond market. And again, it's beating the drum all year, but this one just gets me every time I see it at a truly historic. It was just earlier this year, say June and July and August, it was already apparent just how significant and historic this bond market was. And we've had something like 11 straight weeks of yields to increase from then. So we have just added on top to it. So you can see that this is not a bond market chart that goes back 10 years or 20 years. It's going back hundreds of years, and you can see very seldom have we seen any market that experiences anything like this. You're truly looking at those remarkable major world wars or the South Sea bubble, truly rare events. And that's what we're dealing with in this year's investment environment on the bond side. Partially because interest rates have risen, but also because they started with absolutely no yield. A lot of those bond markets that were bad had a starting bond yield to deal with that to help cushion the fall. None of that was apparent for this year. Taking a look at real estate. So one thing that those rising interest rates hit are certain areas of the market harder than others. And real estate certainly one of those areas, typically hit more harshly by interest rate changes. So here we're looking at the S&P 500 in blue, the overall REIT environment. So the publicly traded REITs, or real estate investment trusts, they're the green mark. And then the orange is the subsector dealing specifically with office. So as you might expect, the office really lagged the overall real estate market on the recovery, especially as we had COVID in the early parts, and then a mixed bag in terms of returning to the office. All of that has helped reinforce this very weak office real estate market, and clearly by a landslide, the weakest of all of the real estate groups. And add to that, from where they are right now, the implications that the Federal Reserve is actually trying everything they can to actually have unemployment go up. Unemployment going up is not a great thing for office occupancy. You certainly will have less need for businesses to have people in those offices. So in terms of our exposure in real estate, where we do have it, office has been something we've been extremely careful about, if at all, in terms of its exposure. And we're certainly not there yet. At some point in time, it's going to make a very good investment, given just how far that it's fallen and what the yields may offer. But for those reasons, we continue to shy away from that sector. Andrew, we're going to flip over now to the technical side. And look and break down the Nasdaq 100.
Yeah, so something that we do quite often in our weekly meetings, and we try to bring a lot of this type of data to you in the Market Carver as well, is looking at the breadth of the market. Remember, the breadth is just the level of participation from individual stocks. We want to know how are the individual stocks acting, because when a lot of them start doing something, that's probably going to drive where the market goes next. And so when we look at the Nasdaq 100, we have to remember that's a lot of technology stocks, a lot of growth stocks, a little bit more volatile than the traditional S&P 500 or the Dow Jones Industrial Average. So the Nasdaq 100, the average stock of those 100, is actually in a pretty deep drawdown. That's what this chart's looking at today. It's the average decline for each of those stocks. And right now it's at negative 38%. So the average decline, some are much worse than that, and some aren't nearly that bad. But the average is 38.3%. And what's concerning for us right now is we look back at the summer when the markets were really showing a lot of weakness. The average stock was only down 37.7%. So the fact that we've kind of edged out that summer level suggests that we're still seeing a lot of these Nasdaq, a lot of these technology, growthy type stocks are continuing to be put under pressure. Now, the good news is we do look at some of the more established indices like the S&P 500, the breadth data does look a little bit better. We're seeing less new 52-week lows, less 6-month lows. A lot of stocks are holding up fairly well. And so that's helping to determine what type of allocations we have within the models that we're managing, where we're trying to find where the levels of growth and the strong stock performance and try to get allocated to those types of the markets. When we look at the Nasdaq 100, we're continuing to see a lot of downtrends, and things aren't looking great on the Nasdaq side of the ledger. Now we're going to take a little bit of shift focus. We're going to look back now at some of the inflation data. So every month we get a look at the consumer price index, and this tells us how much prices are going up each month. And we look at this data from two different views. One is what they call core, which is where we take away food inflation and energy, and we just look at the other components. And then we have headline inflation, which is where we look at all of it together. What's right now, as Adam talked about, the Fed's been raising interest rates, trying to potentially get unemployment to go higher to know when they need to stop. What they're looking at is trying to get inflation to come down. And so the expectation is that inflation will be back to their goal being 2%. A lot of economists think by the second quarter of next year. So think springtime of next year, we should hopefully be closer to 2%. What's hard about that is the path that we have to take to get there. So the inflation that we got looking at September, month over month, inflation was up 0.6%. That was higher than what economists had expected. And we've actually had 5 of the last 6 months have been at least 0.6% month over month growth in consumer prices. And so if we were to stay on that trajectory, and that's what this chart shows, then we'll be tracking that orange line, which would suggest we'll be closer to 7% inflation by next spring. So to get to where the Fed hopes for us to be, we're really going to need to see inflation data start stomping on the brakes, and we're going to need to see it be 0.2% to be that light blue line. That would get us to be about 3% inflation rate. To get to the Fed's goal, we basically would have to see no inflation at all, no inflation growth at all for the rest of the year, and be 0.0 to get that kind of lighter orange, yellowy color line to get us to 1.3. So what this tells us at the end of the day is that the path that we're going to need to see the economy take, to see inflation take, to get to where the Fed ultimately hopes it goes, is going to be much, much slower inflation than we're seeing today. And that's why they're being so aggressive in raising rates. And we think they'll continue to do so in November and December. So we have a lot of work ahead of us to get that inflation rate down if we're really going to reach that ultimate goal of 2% by next spring.
Yeah, they have very well put, as always, Andrew. And I guess we'll see exactly what path that takes. As it stands right now, it seems incredibly unlikely we take either of those extremes, right? But in either case, even in the middle extremes, the Fed still has work to do, and I think that's very clearly part of what's having markets continue to go through an adjustment cycle. Thank you all again for giving us a few minutes of your time. As always, feel free to reach out and give us a call to schedule your appointment, or see us if you haven't already, 800-928-4001. And if you haven't had a chance to work with us yet, would like a complimentary meeting, please, by all means, give us a call or scan that QR code. And everybody, please have a great weekend.